All right, goodwill impairment. So, under US GAAP, the goodwill impairment test allows companies to test qualitative factors to determine if it's necessary to perform the goodwill impairment test. Examples of qualitative factors include, so basically it's saying before you even try to numerically use numbers to determine if there should be goodwill impairment, just think about these non-numerical factors. So macroeconomic conditions, right? Like, is the economy really poor and possibly detrimental to your business? Is the company overall not doing as well? Are there specific events for the entity, such as big bankruptcies, litigations, or changes in management? Anything in the industry, right? Like, is our particular industry declining? Or maybe our stock price is falling? Lastly, any cost factors that could have a negative effect on earnings and cash flow. So before you even do any math, think about these factors. Is it even worth it to do the goodwill impairment test? Oh, and then when the quantitative impairment test is not necessary, if after assessing relevant qualitative factors, the entity determines it is more likely than not that the fair value of the reporting unit is less than the carrying amount. However, when do you move on to the quantitative? When do you do those numbers? Well, if the qualitative assessment suggests that there is a 50% or more chance that the fair value of the reporting unit was less than its carrying amount, right? So pretty general. You're not really going to have to do that. Just know it. Know it for some questions. All right. So here is a nice graphic. If the life of an intangible asset is finite, that means that the useful life is limited to, let's say, 10 years. How do you amortize it over the useful economic life? And then the impairment test, you do a two-step test. First, it's the undiscounted net cash flows, and next is the fair value test. If the asset has an indefinite life, the useful life cannot be determined, or it is perpetual at the moment. So maybe you classify it as an indefinite life because you just don't know what its useful life is going to be. You obviously don't amortize that because there's no life to amortize it over. And then you just use a fair value test.